Imagine turning what many see as a financial burden into your biggest financial advantage. Yes, I'm talking about debt. What if I told you that debt isn't just a pitfall, but can actually pave your way to wealth? Let's unravel how debt can not only be harmless but incredibly lucrative. In today's video, we'll explore Robert Kiyosaki's insights on using debt strategically to amplify your income. We'll dissect the difference between good and bad debt, delve into strategies for using debt as leverage, and provide real-life examples of how proper debt management can lead to remarkable financial growth. Understanding debt in the world of finance. Not all debt is created equal. Bad debt refers to borrowing to purchase depreciating assets like cars or to fund lifestyle expenses, which do not generate income and often carry high interest rates. On the other hand, good debt is taken on to acquire assets that increase in value over time or generate income, such as real estate or a business. This type of debt can be beneficial if managed wisely, as it typically comes with lower interest rates and the potential for returns that exceed the cost of the debt itself. The power of leverage. Leverage in finance means using borrowed capital to increase the potential return of an investment. Essentially, it allows investors to buy more with less of their own money. For example, by taking out a mortgage, you can purchase a property that might otherwise be beyond your cash reach. This can greatly increase your potential earnings from rental income or property appreciation, as the return is calculated on the total value of the property, not just the amount invested. However, leverage also amplifies risks. While potential profits are higher, losses can exceed the initial investment if values fall. Robert Kiyosaki often states, "Your mind is your greatest asset." This philosophy underscores the importance of financial education in distinguishing between different types of debt and using them to your advantage. According to Kiyosaki, savvy investors use good debt as a tool to build wealth. They educate themselves about the market, understand risks and opportunities, and make informed decisions that turn their liabilities into assets. Kiyosaki's approach to debt is not just about borrowing. It's about thinking strategically to make debt work for you, leveraging it to amplify potential financial gains while mitigating risks through knowledge and planning. Strategies to use debt for income. Real estate investment. One of the most common and effective ways to use debt for generating income is through real estate investments. By using a mortgage to finance the purchase of rental properties, investors can create a steady stream of passive income through rents. This approach, often called buy and hold, leverages the bank's money to gain a potentially valuable asset. As tenants pay rent, this not only covers the mortgage payments but ideally also generates excess cash flow. Moreover, over time, the property may appreciate in value, increasing the investor's equity. This method allows investors to control a large asset with a relatively small initial investment, maximizing returns while spreading risk across a tangible asset. John, an IT professional by day, decided to dive into real estate on the side. He took out a mortgage to purchase a duplex in a growing neighborhood. By renting out both units, John's rental income not only covered his mortgage and operational costs but also generated an additional $500 monthly. Over 5 years, the property appreciated in value by 40%. Significantly increasing his net worth. John's strategic use of mortgage debt enabled him to build wealth through both passive income and capital appreciation. Business investments. Entrepreneurs frequently use loans to fuel business growth, which can dramatically increase profitability. This strategy involves borrowing capital to expand operations, enhance product lines, or enter new markets. Strategic business loans can provide the necessary funds to scale operations faster than relying solely on organic growth. For instance, a loan can be used to purchase additional inventory in bulk at a discount, invest in marketing to reach a broader audience, or upgrade machinery to boost production efficiency. By carefully planning the use of borrowed funds, businesses can ensure that the return on investment, ROI, exceeds the cost of the debt, thereby not only covering the loan payments but also increasing overall profits. Sarah owned a small but popular bakery in her town. To capitalize on her success, she secured a business loan to open a second location in a high-traffic area. The loan covered the costs of renovation, staffing, and initial marketing. The second location quickly became profitable, doubling Sarah's overall business revenue. By using the loan to expand strategically, she was able to repay her debt within 3 years while significantly growing her business's value and income streams. Paper assets. Using debt to invest in paper assets like stocks or bonds is another strategy known as using leverage to invest. This can be done through buying on margin, where investors borrow money from a brokerage to purchase more stocks or bonds than they could with their cash reserves alone. This method amplifies both potential gains and losses, making it a high-risk, high-reward strategy. For bonds, investors might use loans to buy high-yielding bonds that pay interest rates above the cost of borrowing, effectively earning a profit on the interest rate differential. Similarly, with stocks, leveraging can significantly increase the return on equity if the stocks appreciate in value. However, it's crucial to have a clear understanding of the market dynamics and the risks involved, as losses may also be magnified. Risks and warnings. While debt can be a powerful tool for generating income, its misuse carries significant risks. Over-leveraging, taking on more debt than one can handle, can lead to financial disaster, including bankruptcy. Misjudging the market or an investment's potential can result in burdensome debts that outweigh the asset's value. This stress not only impacts financial health but can also affect mental well-being and family stability. Additionally, variable interest rates can increase debt costs unexpectedly, further straining finances. Therefore, it's crucial to approach debt with caution, understanding that while it can amplify returns, it can also magnify losses. To minimize the risks associated with debt, several strategies can be implemented. Thorough research. Before committing to debt, conduct comprehensive market and financial analysis to ensure the investment's viability. Maintain a financial buffer. Always have a reserve fund to cover debt payments during unforeseen downturns or slow returns on investment. Use fixed interest rates. Whenever possible, choose fixed interest rates to avoid surprises from market fluctuations. Regular review of financial position. Periodically assess your financial status and the performance of your investments to make timely adjustments. Seek professional advice. Consult with financial advisors to evaluate the potential risks and benefits of your investment strategies. This is particularly vital for complex investments like real estate or stocks purchased on margin. By adhering to these principles, investors can use debt responsibly to leverage opportunities without falling into financial pitfalls, ensuring their investments contribute positively to their wealth-building goals. Getting started with income-generating debt. To navigate the complexities of using debt as an investment tool effectively, enhancing your financial literacy is crucial. Start by reading foundational texts like Robert Kiyosaki's Rich Dad, Poor Dad, which illuminates the concept of good versus bad debt. Websites like Investopedia offer detailed articles and tutorials on financial topics, including leverage and risk management. Podcasts such as the Bigger Pockets podcast provide insights into real estate investment and the strategic use of mortgages. Additionally, online courses from platforms like Coursera or Udemy on real estate investing, stock market basics, and debt management can equip you with the necessary knowledge to make informed decisions. While self-education is important, the complexity of using debt wisely often necessitates professional guidance. Before undertaking significant debt for investment purposes, consult with a financial advisor or a debt counselor. These professionals can provide personalized advice based on your financial situation, help you understand the tax implications of your investments, and develop a risk management strategy. They can also assist in setting realistic financial goals and creating a balanced portfolio that aligns with your long-term objectives. Engaging with experts not only minimizes potential risks but also maximizes the chances of your investment success, ensuring that your ventures into income-generating debt are both prudent and profitable. Remember, while debt can amplify returns, it requires careful management and professional advice. If you found this video helpful, please like, comment with your experiences, and share it to help others learn about the potential of income-generating debt.